Okay, let's dive in. Think about a financial giant, I mean a really big name, woven right into Europe's economy, suddenly teetering on the edge.
Yeah, not just a quick blip either. A long period where Deutsche Bank, a name most people thought was totally solid, looked, well, surprisingly shaky.
Exactly, and
Right.
that's where we're focusing today. We've got this really interesting piece from Cognitive Market Research.
Right, it's called Deutsche Bank Struggles with Risk Management, how over-leveraging led to near collapse.
And our goal here is to really get under the hood, understand the key factors.
Mhm.
How did a bank known for being, well, pretty conservative end up in such a tight spot?
We'll be digging into the strategies, the risks they took on. We'll need to touch on some of those complex financial instruments too.
Things like structured finance, derivatives,
Mhm.
proprietary trading, the stuff that carries big risks.
Precisely. So let's start there. What was the big change? What set them off on this different path?
Well, the article points to a major shift starting back in the late 90s, but really picking up steam in the early 2000s.
It was a conscious move, wasn't it? Away from their traditional base, like European retail banking.
Yeah, and aggressively pushing into global investment banking. Much higher stakes, more competition. They wanted to be a huge player, like on Wall Street.
A real U-turn, and executives like Joseph Ackerman were key figures in driving that ambition.
That's right. And they had that specific target, and the article mentions a 25% return on equity. That sounds ambitious, very ambitious.
It was incredibly high. And, setting a target like that, it changes things internally. It really reshaped the bank's priorities.
How so?
Well, hitting that number became the be-all and end-all. It kind of incentivized, maybe unintentionally, a culture where you needed rapid growth, big yields.
So caution maybe took a back seat.
You could say that taking on significant risks, even risks that maybe weren't fully understood inside the bank, became, well, almost encouraged. It was the way to get ahead.
And to hit that 25%, they loaded up on those complex instruments we mentioned, mortgage-backed securities, credit default swaps.
Yeah, loads of them. And here's a critical point the article makes. The bank held huge amounts of this stuff, but internally, the understanding of the actual risks involved was often lacking.
So they didn't fully grasp what they were holding.
It seems like they knew how to trade them, maybe, but the deep underlying risks in a crisis scenario, not so much. A real vulnerability there.
And what about the risk management teams? The people whose job it was to understand and flag these things.
That's the key part of the story. The article suggests they were often under-resourced. Their warnings didn't carry the same weight as the potential profits coming from the trading desks.
So a power imbalance, profit focus versus risk focus.
Exactly. The drive for those returns often just outweighed the prudent risk assessment.
Plus, they were operating globally, right? Lots of different departments. Must have been hard to see the whole picture.
Absolutely. Geographic spread, internal silos. It made getting a clear, unified view of the total risk exposure really difficult.
And their risk models.
According to the research, the models just weren't really equipped for the absolute worst-case scenarios. They didn't fully capture how interconnected all these different risks were across the whole bank.
The article also mentions opaque accounting practices and using off-balance sheet vehicles. Sounds like ways to maybe make the risks look smaller than they were.
Well, off-balance sheet vehicles can be used legitimately, but they can also, yes, make it harder to see the full extent of a bank's debts and exposures. It obscures the picture for investors, for regulators.
Less transparency.
And that lack of transparency in accounting just adds another layer of difficulty in really understanding the underlying risks involved in some transactions.
Okay, so they're operating with high leverage, complex products, maybe not fully understood risks, and some lack of transparency. And then bam, the subprime mortgage crisis hits.
Exactly. That was the moment of truth. The crisis acted like a massive stress test, and those underlying weaknesses at Deutsche Bank got, well, laid bare.
They initially claimed they were doing okay, though, didn't they? Compared to others.
They did put on a brave face initially, but the research suggests they avoided a much, much worse fate, mainly because of government help and central bank liquidity injections.
Not because their own risk management was superior.
That seems to be the conclusion. The need for that external support really highlights how serious the internal situation actually was. They were holding a lot of those mortgage assets that suddenly became toxic.
And leveraged trades that just plummeted in value.
Right. And unlike some competitors who maybe moved faster to cut their losses and reduce risk,
Deutsche Bank struggled. Why was that?
The sheer complexity of the products they held, plus that web of off-balance sheet stuff, made it incredibly hard and slow to unwind those positions. It wasn't straightforward to just sell things off.
Like untangling a very complicated knot.
A good analogy, banks with simpler portfolios, or those who just reacted quicker, managed to de-risk more effectively.
Now, this next point is pretty staggering. The leverage ratio. The article says it hit over 40 to 1 at times.
Astonishing, isn't it? $40 in assets for every $1 of their own capital.
And that fast fact mentioned, a tiny 2.5% drop in the value of those assets could have wiped out all their equity.
That's the math. It shows just how incredibly thin their safety buffer was. Very, very little room for error or market drops.
So when the market did drop significantly,
The potential consequences were catastrophic. It magnified every loss.
and the problems didn't stop with the market crisis itself. Afterwards came the fines, the legal battles.
Billions of dollars. Fines related to the mortgage crisis itself, manipulating the LIBOR interest rate, dealing with sanctioned countries, a whole slew of issues.
Each one a major financial hit.
Yes, and the damage wasn't just financial. Think about the hit to their reputation, to investor confidence. That kind of erosion of trust is incredibly damaging long term.
Makes it harder to raise capital, keep clients happy.
Exactly. And the article contrasts this with some competitors like Morgan Stanley or Citi, suggesting Deutsche Bank's own structure made it harder to respond effectively.
How so? What was it about their structure?
Just the sheer size, the sprawling operations, as the article puts it. Decentralized governance, departments not always aligned. It hampered their ability to make quick, decisive changes compared to maybe more streamlined banks.
The lack of unified direction, maybe.
That seems to be a key theme. When you're that big and fragmented, pushing through major changes or responding to a crisis effectively becomes a huge challenge.
So even after surviving the immediate 2008 storm, they weren't really out of the woods. These internal problems continued to drag them down.
Right. The article points to the period between, say, 2012 and 2018, lots of CEO changes.
Yeah, frequent turnover at the top.
And each new leader seemed to bring a slightly different strategic vision. Should they push investment banking again, go back to their roots in retail, that kind of constant
So it
shifting?
leaves the bank without a clear identity, right? Hard for employees, for the market to know where they're heading.
Creates a lot of internal uncertainty, makes it almost impossible to execute a consistent long-term plan. They lacked that stable direction.
And did the culture change? The attitude towards risk?
The research suggests those underlying issues persisted. Risk management might have gotten more attention on paper, but was it truly embedded? The article implies it was still sometimes seen as a box-ticking exercise.
Those silos between departments remained. Resistance to better controls.
Cultural change is slow, especially in massive firms. It seems the old ways, the resistance to fully integrating risk controls into every decision, didn't just disappear overnight.
And despite trying to cut costs, they were still stuck with high overhead, complex structures.
Yeah, shedding that complexity and cost proved really difficult. And then you had the failed merger talks with Commerzbank in 2019.
Right, that was seen as a big sign, wasn't it?
Yeah.
That maybe the market still has serious doubts about Deutsche Bank's health and future.
It definitely signaled ongoing skepticism. Another major institution basically looked at integrating and decided the challenges were too great.
Meanwhile, inside the bank, the article talks about employee morale suffering, layoffs, smaller bonuses.
Understandable, given the constant restructuring, the negative headlines, the uncertainty. And clients and investors remained wary too because of the ongoing legal and regulatory issues.
So instead of really recovering and moving forward strongly after the crisis,
They found themselves kind of stuck, constantly reacting, dealing with legacy problems on the defensive rather than proactively shaping their future.
okay, so stepping back from the specific Deutsche Bank story, what are the big lessons here for other banks or even, more broadly?
I think the research points to some really crucial takeaways. First and foremost, risk management absolutely has to be part of the core strategy.
Not just a separate department you check in with occasionally.
Exactly. It can't be secondary when profit targets are the main driver. It needs to be woven into the fabric of decision-making right from the top.
That makes sense. The drive for profit can't completely overshadow understanding the potential downsides.
Precisely. And second, the critical role of culture and leadership. You need consistency, especially around compliance, ethics, and how much risk is acceptable.
Mixed signals from the top or constant changes in direction, that undermines everything.
It really does. You need that cultural alignment, that clear tone from the top that prioritizes responsible behavior and long-term health.
And for big, complex outfits like Deutsche Bank, the article stresses things like unified reporting systems, clear governance.
It's essential. You need transparency. You need clear lines of accountability.
Yeah.
Without streamlined systems and governance, those internal silos persist, and getting a true picture of overall risk is nearly impossible.
It sounds like a call for better plumbing, almost. Making sure the information flows correctly and everyone's looking at the same data.
That's a good way to put it. And related to that is maybe a dose of humility and strategic planning.
Meaning,
Meaning not overreaching, not trying to be something you're not equipped to be, or chasing extreme risks without the infrastructure and the mindset to actually manage them properly. Know your strengths, know your limits.
so don't just copy the most aggressive players if you don't have the same foundations.
Right. Ambition is fine, but it needs to be grounded in a realistic assessment of capabilities and crucially robust internal checks and balances.
So it really boils down to balance, doesn't it?
Right.
Balancing that ambition, the drive for returns, with strong internal controls, a clear long-term vision, and a culture that genuinely values stability.
That sums it up perfectly. Risk is part of finance, obviously, but it has to be managed consciously, strategically, and culturally, prioritizing that long-term sustainability.
Okay, so let's quickly recap the main points. We saw how unchecked ambition, when it's not balanced by really strong risk management, can put even a massive institution like Deutsche Bank in a dangerous spot.
Definitely. And the huge impact of leadership needing consistency there and the fundamental importance of an ethical, risk-aware culture.
Plus, for complex organizations, transparency, clear oversight, good systems, they're not optional, they're critical.
And it's a powerful case study in why learning from mistakes has to go deep. It's not just about writing new rules, it's about changing how the organization fundamentally thinks and operates.
It really does make you think. These lessons about risk, ambition, oversight, culture, they feel universal, don't they? Beyond just banking.
Mm-hmm.
You could apply them to almost any field, any business decision where there's a potential big upside, but also significant downside, even maybe personal decision. It leaves me wondering, what kind of leverage ratio are you operating under in your own work, or maybe even your life? Definitely some food for thought there.